Hi folks, welcome to this video on preparing journal entries and financial statements. In this particular question, what we're going to do is we're going to make journal entries to record share retirements, issuing new shares, as well as share dividends, and also make a journal entry to close our income summary account to update our retained earnings. So let's begin. In this question, what you can see you'll see in this question that it starts you off with information on the equity section of the balance sheet, and you can see here that the dividend on a per share basis on the preferred shares is $2, and there's 10,000 shares authorized. We have issued and outstanding with 50,000 authorized. You can see here that for the common, authorization is unlimited, and we have 50,000 shares that are issued and outstanding, and we also have a balance in retained earnings. Now, during the year, we did have some retirements. You can see here on February the 1st, we had some dividends declared in March. Some of them were cash, some of them were share dividends. And on June the 5th, we issued some more preferred shares. July the 13th, we issued the cash dividend as well as the share dividend. And for the year 2010, we recorded a loss. So now what we need to do is we need to prepare some journal entries and also prepare a statement of changes in shareholders' equity as well as the equity section of the balance sheet. Notice at the end I did ask you to do a little calculation for the average issue price per common share at December 31st and to do the same thing for the preferred shares at the end of the year. So why don't we begin our approach to the problem. First thing you want to make sure that you can see is that whenever you see your retiring shares, the first thing you need to do is figure out how much am I going to debit the share account for. In this case, we'd have to debit the common share account because we are going to be removing or debiting the common share account for some amount of equity. And how do we determine what it is? Whenever you are retiring a share of any type, whether it be common or preferred, you have to calculate the average issue price of the share class that you're retiring. So make sure you calculate the average issue price, in this case for the common shares, because you need to debit or remove a balance from the common shares, which is equal to 2,000 times that average issue price. We use the average issue price because we're saying on average, we know that shareholders gave us 400,000 for the 50,000 shares we gave them. So on average, the shareholders gave us $8 a share, right? 400,000 divided by 50,000. And that's the amount at which we are going to remove each common share from our common share account, right? And in this case, we're removing 2,000. So what does our journal entry look like? Well, if we flip over here, we're going to debit our common shares for, again, 16,000, which is 2,000 shares being retired, times $8 a share, and we've got the calculation down here for you. But don't forget, in the question, it said that for each share that we retired, we had to pay the investors $7 a share. So we credit or pay out our investors $7 a share times 2,000 shares, which is 14,000. So you can see we paid them less on a per share basis, $7, than they actually gave us an average. So it's almost like we have a gain, right? Because we paid less than what they gave us to retire the shares. However, we can't credit a gain account because gain is income and we're doing an equity transaction. So we credit an account called contributed capital on common share retirement. And remember, when we retire common shares and we need contributed capital or need to create it or increase it, we're going to credit contributed capital, and we have to specifically say that it is for common share retirement because it's common shares that we're retiring, right? So make sure it says common shares, and it's going to be for the amount that you need to plug the hole there, which is 2,000 to balance the entry. We also know here, if we go back to our question, that on March the 18th, we declared a cash dividend on the preferred shares. And again, we have 10,000 preferreds at $2 a share, so that's going to be 20,000. And we're also declaring a 2% share dividend. Now, one of the things you got to remember here is that because in February we retired 2,000 shares, we're only going to declare a 2% share or stock dividend on the number of shares we have left, which is 50,000 less 2,000, and that's going to be 48,000. So if we go back to our journal entry, we're going to debit our cash dividends account, which is like your dividends declared, and we're going to credit dividends payable for $2 a share times 10,000 shares. And how much are we going to debit the common share dividends account for? Well, that's going to be 2% again times 48,000 shares, right? Because we had 50,000, but we retired in February, we retired 2, so we got to take them away because whoever held those 2,000 shares no longer holds them. So we're only going to issue a share dividend on 48,000. Now, at the date that we declared the share dividend, the shares were trading at $10 a share. So remember that when we multiply by $10 a share here, that's the value of the shares at the declaration date. So we're going to debit our common share dividend and credit our common share dividend distributable account for $9,600. Remember the distributable account, we've talked about that account before. It's not a liability, it's a shareholders' equity account. Now, on June the 5th, what did we do? We issued some preferred shares. In fact, the question told you that you issued 5,000 shares for $55 a share, so therefore we're going to debit cash and we're going to credit preferred shares for $275,000. Now, on July the 13th, we do two things. We issue the share dividend and we pay out the cash dividend on the preferred shares. So you'll notice here, we credited dividends payable back in March. So now in July, we're going to debit that account and credit cash. Notice here on March the 18th, we credited the distributable account, which we're going to debit now, and credit the common shares. So it's only when you issue the shares that you credit the common share account. All right? Now, at the end of the year, two things happened. First of all, we need to update all of our equity accounts because we know we have to do a statement of changes in equity as well as calculate the ending balance of retained earnings to update our equity section. So we need to make sure that we close all the cash dividend and common share dividend accounts. So we're going to credit those accounts. Those are our declaration accounts because they have normal debit balances. We're going to credit them to close them and debit retained earnings to reduce it. And in the question, you notice here, we tried to trick you a bit and tell you that we had a net loss of $56,000. So when the company has a loss, that means in our income summary account, we have a net debit sitting there of $56,000. So to close the income summary account, we're going to credit it because it has a debit balance right now because we recorded a loss, and we're going to debit our retained earnings. So now, to do our statement of changes in shareholders' equity, we're going to start with all of our opening balances. And notice here, even though I didn't have a contributed capital account at the beginning of the year, I put one in now because I know I credited back in February earlier this year. I credited that account, so I created it. So whatever accounts I have at the end of the year for which I'm doing my statements, I have to make sure, even though it might not have been listed in the beginning of the year, that I have it at the end of the year, right? So in other words, if I go back here, you'll see I don't have a contributed capital account at the beginning of the year, but I created one on February the 1st, right? So because I created one, you can see it right here on February the 1st, right? I better make sure that at the end of the year, I have it listed here, but it has a zero balance at the beginning of the year. So I start off with $1.35 million in shareholders' equity. But during the year, I debited my common shares to decrease that account, and I increased my contributed capital account when I retired the shares. So now my net impact on equity with that transaction was to reduce it $14,000. I issued some common shares, or preferred shares I should say, so that increased my equity by $275. I also issued common shares, right? Remember the share dividend that I issued back in July? So that's going to increase my share equity by $9,600. But I also had a loss, which reduced retained earnings and reduces equity. I also had to close out my cash dividends account and my common share dividends account, which reduced retained earnings and reduced equity. So now my total values in my equity accounts at the end of the year are preferred shares $775,000, common shares 393.6, and don't forget, all I'm doing is adding up what's in here, eh? I only haven't contributed capital when I added up 2,000. When I add up all these fellas here, I get 364.4, and when I add all these up, I should get 1,535,000, which is the same as if I added this row across. All I got to do now is take these numbers on this last totals row from my statement of changes in equity and plunk it into my partial balance sheet in the equity section. So I take so that's why I got the arrows here for you. So you can see I've taken my 775 from my statement of changes in equity, and it's now my preferred share balance. The only thing you have to be careful of here is to remember that the number of shares outstanding now is not 10,000 as it was originally in the question. You issued another 5,000, so you added 5,000 shares to what's outstanding. Your common shares, again, the balance is right from your statement of changes in equity, but don't forget what happened. At this time, you don't have 50,000 like you did at the beginning of the year. See, at the beginning you had 50,000, right? The beginning of 2010, that's what you had. But that's not what you got now, because don't forget, from that 50,000, in February of 2010, you retired 2,000. But then don't forget, you declared and issued more common shares when you issued the share dividend. And that was 2% on 48,000 shares. That number alone, 2% times 48,000, gave you an extra 960 shares, which I added, right? So now I got 48,960 shares, right? My contributed capital is 2,000. My retained earnings, again, I get it right from this little fella here. So my total equity is 1,535,000. Now the last thing I have to do is calculate my average issue price for my common shares and my preferred shares, and you'll notice all I'm doing at the end of the year is I'm taking my total dollar value of in the common share count. That should actually be, guys, a 6. Eeks. There we go. And I'm dividing it by 48,960, which is the number of shares I have outstanding, which is going to give me $8.04 a share. And then my preferred shares, 775, which is my preferred share equity, divided by the number of shares outstanding, which is 15,000, it's going to give me $51.67 a share. So this concludes our short video on making journal entries and preparing statements. I hope you found it helpful.